Okay, I guess we'll get going, and I'm sure the other participants will join us as we go along. Again, hello everyone. I'm Justin Martel, and on behalf of Marie Bruyère and Sophia Ramos, it's a pleasure to welcome you to the second webinar organized by the ESSEC-Amundi Chair for the 2023 season. I would also like to thank Vanessa Thomas for the logistics. Over the last 2 years, for those who've been attending the webinars, the ESSEC-Amundi Chair has been organizing a series of webinars and on a number of ESG-related issues. Today's webinar focuses on the link between ESG and the supply chain. Modern companies rely on supply chains that may span multiple countries and involve numerous suppliers, making it difficult for companies to monitor and manage their operations effectively. As a result, supply chains can be a significant source of ESG risk for companies, which may face reputational damage, legal and financial penalties, and supply chain disruptions if they fail to manage ESG risk effectively. In addition, investors and consumers are increasingly demanding greater transparency and accountability regarding supply chain practices. The two papers in today's program provided new evidence on the spillover effects of ESG issues to the supply chain. The first paper, presented by Guillaume COQUERET from EM Lyon, analyzes the impact of ESG news on firm stock return, as well as on their suppliers and clients' returns. The second paper, presented by Ai Lu from the University of Toronto, analyzes the impact of mandatory ESG disclosure on firms' global supply chain management. As usual, participants are encouraged to ask questions on the chat. They will be answered at the end of each presentation. I'm now turning over to Marie Bruyère from Amundi and the co-head of the chair. And I wish you a very good webinar. Marie?
Thank you very much, Jocelyn. So my name is Marie Bruyère. I'm the head of Investor Intelligence and Academic Partnership at the Amundi Institute, co-head of the ESSEC-Amundi Chair on Asset and Risk Management. And it is my great pleasure to welcome you today, together with Jocelyn and Sophia, to this webinar on ESG and value chain. So understanding the production network relationships in firms' value chain is key for ESG. And as Jocelyn mentioned, investors are increasingly more aware and they're monitoring these relationships today. First, firms are engaged in international production networks and they may be indirectly exposed to climate physical risk, for example, because of their suppliers or customers. And second, supervisors around the world are now mandating firms' disclosure of their extra financial information, in particular their carbon emissions. And the issue is that mandatory ESG disclosure has incentivized firms to transfer their controversial activities to suppliers operating in countries or states with lower ethical standards. But supervisors are now starting to mandate Scope 3 disclosure, if we consider carbon emissions, eliminating the potential for companies to externalize part of their Scope 1 and 2 emissions. So in that environment, it is key to understand global supply chain relationships, and in particular, how climate risk, or more generally ESG news, and that's the topic of the first paper, can propagate along the value chain. And second, how firms are strategically redefining their supply chain relationships to reduce their risks or escape their ESG obligations. So I'm really glad that we can welcome today two prominent speakers with great papers on this topic, Guillaume COQUERET and Ai Lu. And I would like to thank both of you for your participation. And of course, thank also Sophia, Jocelyn, and Vanessa for a great partnership between ESSEC and the Amundi Institute. And last but not least, I would like to thank all of our colleagues. You were very numerous to register today, colleagues and partners that are attending the conference. So thanks to all of you for being there, and I hope you will find it useful.
Thank you very much, Marie. Guillaume, you're the first, so I'll let you upload your slides. And as I mentioned, you have 35 minutes presentation, more or less, and we'll ask questions at the end.
Thank you, Jocelyn. Can you all see my screen? Yes? Perfect. Thank you very much, Jocelyn, Marie, and Vanessa for the invitation. The paper I want to present today is joint work with Rotman from Nord University. And we are very lucky because it has been accepted 10 days ago at the Financial Management Journal, which is a small but selective journal. Because I don't have too much time, I'm going to move forward to the interesting parts. And first, the motivation. So the motivation is relatively anecdotal if you look at the slide. And it deals with some particular events that have been shared among the media with respect to some scandals, if you want. For instance, if you take the Foxconn scandal for Apple, whenever there is such a scandal that is linked to a firm, there is a risk for, of course, the financial performance, whether it be earnings or even stock market prices, if you want, for the affected firm. So here, the idea is that if Foxconn is in a scandal, for instance, with respect to child labor policy, this is going to impact the reputation of Apple with possibly consumers saying, okay, we don't want to buy phones or computers from a company that resorts to child labor. Okay, so there is a huge potential risk. So this is one anecdote for Apple. There is also anecdotes for Tesla, for instance, again, as shown on the screen. And here it's the same reputational risk. So from these two examples, we see the risk for suppliers where you don't want to be associated in the value chain to particular scandals where here they are related to child labor, or they could also be related to environmental pollution, for instance. There is also the opposite, if you want, reaction, where it's your client that faces a scandal. And in this case, if one of your major clients faces a scandal, then the problem is that the sales and the profits of your clients are likely to shrink, in the future. And then it's going to impact you because they're going to be less future sales for your own company, which again is going to impact likely your future market value. So those are the two possible chains that we investigate in the paper. And the conclusion, so very briefly in summary that we reach, so that's the literature, sorry. The literature starting point for the paper is the following. So as we all know, especially Marie, because she works at Amundi, is that ESG is a super trending topic for investment firms, either because they believe in ESG or because they feel that they don't have the choice because of regulatory pressure, especially from the SFDR in Europe. So because it's important for investors, it also is going to become very important for firms and the real economy, either because also they believe in it, or because they're going to have to face regulatory pressure, typically from the CSRD, again, in Europe, for instance. And there has been several contributions on that. Here I'm listing just a few of them, but there are more like hundreds of them in the literature, in the landscape. So some papers document that you do have investors that are willing to pay a little extra, or to sacrifice a little extra bonus to acquire green firms, okay? Which means that in terms of future returns, for green firms, the expected returns are slightly lower. So you have a series of two papers back-to-back in the JFE by Pastor and Stambo in 2021, and then Avramov, Liwi, and Tarelli in 2022. And at the same time, you could have reverse effects, which are that positive ESG shock, so being virtuous as an ESG shock, can also lead punctually, if you want, to price appreciation, okay? And so the question that we address in this paper is, okay, what happens when a firm has an ESG shock because you have data providers nowadays that update their data almost in real time. Okay, so daily, it's already a relatively high frequency, but even intra-daily sometimes. And so what happens to the prices of firms where their own ESG is impacted during one day? But then what happens to the suppliers and the clients of these firms when you have this ESG shock? Okay, so what we're going to see, and that's the contributions that I wanted to go too quickly in the previous slide, is that we find that there is a pretty strong shock to the stock price whenever there is an ESG shock to the firm on the same day of the shock. So it's like strong efficiency à la fama, if you want. The news is priced almost instantaneously. And then what we document in the value chain is both a slightly smaller effect in terms of the magnitude of the shock, okay, from the client or from the supplier. But also we see that there is a small delay, meaning that whereas for the direct effect, the impact is instantaneous, meaning in the same day, when it hurts or it benefits your client or your supplier, the effect takes a little longer. Okay, so which kind of makes sense because people have to realize, and you have decision processes or investment processes that react more slowly, even if it's like 1 or 2 days later. But the reaction is not immediate, and it takes 1, 2, or 3 days before it materializes on the stock market. So that's the most important finding that we have in the paper. And then, of course, because of reviewers, referees, etc., we had to dig a bit deeper. And so they asked us a few questions, which means conditioning your results to particular subcases. And so what we did is we ran the same kind of analysis, but on 2 sub-periods. One period before 2017, which is a proxy for us for the Paris Agreement, and then one period after 2017. And what we see is that most of the effects that we report, especially in the value chain, are slightly stronger after 2017, which is consistent with this idea that you have both more interest in ESG after 2017, which is kind of obvious normally to all of us, but also that you might also have a better technological integration, meaning that we are able to process the information faster in the later years because of computational capability, if you want. So this is another interesting finding. And also, we have also split our sample, not across time, but across firms. And we did a separate analysis between small, medium, and large firms, for instance. And what we see is that the effects that we report, again, are stronger for small firms. And so when we try to rationalize that, basically, we think it's a matter of surprises and coverage from analysts, because basically small firms are less covered or less well covered than large firms, because if you take Tesla or Apple or I don't know, Microsoft, Walmart, etc. Of course, they have loads of analysts that are working on these firms, and you have fewer surprises because the coverage is very well done. But for smaller firms, we don't have that, so you get more surprises, so the effect could be larger. And finally, and something that I will probably not mention, we have a small theoretical model, which I postponed to the end of the talk because I probably won't have time to mention it. But again, if you are interested, you can have a look at the model in the paper. It's on SSRN, so feel free to browse and download it. So now to the core of the study. So the data comes from my co-author, Vu, and so he made a huge amount of work to aggregate 3 types of data. First, we have ESG data, which comes from True Value, so a major data provider in ESG, And the good thing with True Value is that it has daily points. Okay, in many cases, data is not necessarily daily, can be monthly, can be yearly, because many fields, especially from annual reports, are only updated on an annual basis. So in some cases, there is no need to have high frequency data. But for True Value, they do keep it because they have a rating mechanism that adjusts the whole cross-section of scores whenever there is a news in one particular firm. And what they do, they also have two types of scores for ESG. They have what they call ACP, so all categories pulse, meaning that they take the full scope of ESG metrics. And they have a second indicator, which they call the MP, the material pulse. And so it's this is restricted to the dimensions, or the pillars or sub-pillars or sub-issues that are really financially material to the firm. And so we will use, and we'll see whenever there are differences between the two types of indicators. And so these scores, we normalize them between 0 and 1 in the cross-section to make sure that everything is comparable across time, which is relatively standard practice. So that's for ESG. Then we have FactSet for prices and return, because we are really interested in working with asset returns. And then we have the last part, which is also tough, and which is FactSet River. And this tells us which are the links between the firms. And so to ease the study, we only focused on the major supplier, I mean, the largest supplier or the largest client of the firm. So whenever I have an ESG shock, basically, what is going to happen to my largest supplier or to my largest customer? Okay, we didn't do pools, etc. We just looked at the likely most impacted firms. And so on top of all of that, we are going to use control variables for returns to make sure that we control for traditional asset pricing factors. And so we picked the standard 2015 FAMA French factors, so the 5 factors, plus the momentum factor. So we are very well covered in terms of asset pricing. And then for the inference, it's not said here, but it's said in the paper, we use particular clustering for standard errors to make sure that we have relatively accurate T statistics. And so our data runs from 2007 to 2021. Just checking the clock. Okay. So the first model that we estimate basically is the following. So I hope you won't mind the notation. The notation is a bit heavy, but basically you see that there are 2 parts. We look at the excess return of the stocks of stock N here. And the first specification is the direct effect. And so here we have lags. At first, you considered 5 possible days of lags, but the tables were too big, so we shrank to 3 days, which is enough, in fact, because going to day 4 and day 5 does not add any value, and it doesn't change the results at all. So basically, keeping just 3 days of history of memory for the shock is enough. And so the first value here is, are my returns impacted by the shock in ESG? So that's the delta G. So the G is the score in ESG. So this is the shock in ESG. And we see that we start at 0. So we allow for synchronous shock on the same day. And then we have a second term, which comes from our theoretical model, which looks at a cross effect of not only the shock in ESG, but at the cross effect between the level of ESG and the shock. Because at least that's what we get from the theoretical model, the shocks are not necessarily going to impact the cross-section of stocks uniformly, meaning that the level of ESG, meaning if you are a very virtuous firm, a very green firm, or if you are a brown firm, if you want, is maybe not going to have the same impact when there is a scandal. So we can control for the level of ESG, with this second term here, which we call the cross term. And then we have all the controls that I talked about, the FAMA French and momentum variables. And so I see a question. Should I answer now, or do I keep it later on?
We can keep that for the end, Guillaume.
Thank you, Isla. So that's the first model. The second model, second and third, but they are the same, is to basically do the same, but instead of looking at the direct effect, here I look at the returns of the supplier, and I'm trying to explain the returns of the supplier with the same kind of variables, but that come from the customer. Okay. And likewise, I'm going to do the mirror study, which is looking at the returns of the customer as a function of the scandals or the change in ESG from the supplier, with also the same relationship with the cross term from the supplier.
And maybe a clarifying question, Guillaume, why not including all in the same regressions? So the cross effects and the direct effects, you seem to separate both.
It's a good question, Marie, and I wonder if it's not done, in fact. So I'm sure we did it, but I don't know if it's like inside the 3 points here in the controls, or if we did it as a robustness check. But I know we did it.
Okay.
From the bottom of my head, it doesn't change anything.
Okay.
But yes, it's an important point. We have to control for their own effects. And so I do think it's in the baseline specification, because I think it's one way that we interpret that the coefficients are less strong compared to the direct effect only. Mm. So I think the values for the supplier here are inside the 3 little points, because we control for the own effect as well. Good point.
Thank you.
Okay, so we have basically 3 regression models. So sorry, it's going to be a panel model. And now there's just different ways of running the analysis. So the first, so I hate tables that are presented like that, but I mean, we had no choice. So I'm just going to comment on the red figures because they are the ones that are the statistically significant. And please don't look at the table, it's going to be ugly. But first, we document the first equation. We have the 3 lags here. So basically no lag, lag 1 day, lag 2 day, lag 3 day. So that's for the direct term. And this is the cross term with the same lags, lag 1, lag 2, lag 3. So no, except for the level, which is only lagged once. And so what we see here from the direct effect is that the strong coefficients, okay, the red ones here, are the ones that are linked to the instantaneous, so synchronous delta G, so synchronous shocks, meaning that whenever you have a shock on one day, say, I don't know, yes, Foxconn has a scandal, then the stock of Foxconn is going to be impacted daily because markets are going to react automatically on the same day, okay, except if it's really, really late in the day, but usually it happens in the middle of the day. So we do find a strong impact, but the impact is synchronous. And we see that what is reassuring, but because there is a large correlation between the 2 measures, but there is the same sign between the full ESG scope measure and the materiality focused measure. Okay, and also what is nice, and it's close to the papers of Seraphim and Yoon, for instance, is that the impact is positive, meaning that if you have a positive shock, meaning good ESG news, the impact on the return is also going to be positive. Okay, so that's the first baseline results that we have. We here show the impact of the 2 leading terms, which are the 2 red terms here, because we have the mitigating factor, which is kind of strange to interpret. And so we provide a graphical explanation of what happens in terms of it's GT. Yes, in terms of GT, the level of ESG. And this is kind of strange because we see that the impact of GT, so the level of ESG, is negative. And this is something we could not really reconcile with, I don't know, intuition, meaning that if there is a shock of plus 0.1, so a positive shock to the ESG, basically it's going to benefit the brown firms and it's not going to benefit the green firms. So maybe it's a matter of reputation. So you have a brown firm that is going to benefit from a good news, and so it's going to shift demand for the brown firm, but it's not necessarily super clear for us. Then we move to the second model, which is the supplier, the customer to supplier shock. And here, so first, the magnitude of effects are smaller, which is a byproduct of what Marie was talking about, meaning that we have included the own shocks of the supplier inside the equation, which already takes into account, so it's already impacting the return. So now we have fewer room for coefficients, if you want. So we have less significance, okay? We see that the t-stats are much lower. But for those for which we have significance, we also see that it's no longer synchronous. So it's no longer the delta G or the delta G times the level of ESG. But here it takes 1 day for the news to translate to the return. Okay, and for both variables, the shock and the cross term as well. And if we move towards the second specification, which is the opposite, where we explain the customer return with the supplier return, same kind of conclusion. We have smaller terms with less significance. When we have significance, it's at larger horizons, meaning that the news takes a bit longer to diffuse, and here it's 2 days. An interesting pattern also is that we see that the stars are mostly located to the right, here in the MP section. Same thing here. We have 2 stars here. Well, here we have one and another one here, but the effects are stronger with the materiality pulse, meaning with regards to the dimensions of ESG that are financially material. Okay, so indirect, weaker effect, and takes longer to diffuse, which is kind of intuitive, at least for us. And so then we had a question of, you know, if you're an investor, is it possible to benefit from these effects? And so what we did is a traditional sorting experiment, where what we did was first sorting across ESG firms, because we wanted our portfolios to be ESG neutral. So we looked at deciles, I think, or quintiles of ESG firms, and then within these deciles, we looked at the positive versus negative shocks. And then standardly, we looked at the 1 day ahead return of the portfolio, because again, we are the daily frequency. And overall, we did the exercise both for the customer return and for the supplier return, because in fact, like we've seen in the first batch of results, since the impact is synchronous for the direct effect, because it's synchronous, you cannot benefit from it during the next day, because the impact is already diffused in the price. So we could only do it when for the supplier versus customer relationship, when the news took 1 or 2 days to diffuse. So that's why we don't do it for the direct effect. because there is no money to make in the direct effect because the diffusion is instantaneous. And so we find, even though we have some red figures in the table, that the results are disappointing, in fact, if only statistically speaking, because we don't have super large significance levels. And we feel that it's maybe because the original coefficients were, even though statistically significant, maybe slightly weak in terms of effect size, if you want. Meaning that the effect is not strong enough to be able to generate future really strong positive returns in a portfolio sorting exercise. So that's the first batch of results, but I'm going to go fast because we need time for Q&A. Then, like I said, we did subsampling. So same kind of exercise, but splitting in two. So here we see before 2017, after 2017. And basically, if you look at effect sizes, we see here 0.08 versus 0.18, here 0.07 versus 0.14, here 0.18 versus 0.37. Well, basically, you double the effect after 2017. Okay, and so that's the direct effect. So clearly much stronger, same thing for the p-value, which seems to indicate that there is more interest, or at least that investors and markets follow ESG and ESG shocks more closely after the Paris Agreement, again, because the trend in ESG has been very, very steady since then. So this was a good finding. We did the same for the indirect effect. So that's one of the tables. We confirm the results that we had before, meaning that the effects are stronger after 2017 in this case. We have like zero statistical significance before 2017, and we have some after 2017. So the results are stronger. Which confirms what we wanted to say, which is nice. But in this table, and it's the only one for which we have a little issue, it's kind of the opposite for the material pulse. And we did not want to do p-hacking or whatever. So we reported the table with the results that we had. We were a little bit disappointed. But in this case, the results are reversed. When we look at explaining supplier returns with customer returns with supplier variables. So this is like a little thing that we cannot rationalize or that doesn't fit our narrative, but we still kept it for the sake of transparency and scientific integrity. Lastly, we did the same kind of exercise, but across market capitalization of firms. So we split across large, medium, and small firms. And what emerges is that statistical significance is never located in the large firms. Like I said, we think it's a matter of coverage, and more within small firms, especially here and here. And again, we interpret that as being a matter of coverage with you have more surprises from small firms whenever you have an ESG shocks, and typically larger firms are maybe less prone to that kind of surprises. We did the same for ESG attention because my co-author was able to get volumes of ESG news, and so whenever you had lots of coverage of ESG news, we said it was high ESG attention, and whenever you had low coverage, it was low ESG attention. So we split the sample likewise, and it confirms what we are saying in the previous slide, which is that it's really in the low to medium attention that you have all the effects, because that's where the surprises come from. Tic-tac. Then we looked at prior returns as well. So that's in line with the question of Marie of adding maybe some controls. So looking at diffusion effects of prior returns and basically it does not change the results and the conclusions, the signs, and not even the magnitudes of our prior results. So that's just really a robustness check. Okay, so I am done. I tried to be relatively fast, but the conclusions I'm going to repeat them one last time. So direct effects, very strong but synchronous, meaning shock means price adjustment during the same day, and unless you're able to do high frequency trading, so maybe using intradaily ESG or intradaily returns also, it's not possible to benefit from that. Okay, if you have daily data, it's too late. With respect to indirect effects, so customer to supplier or the opposite, we also document an effect, but it's weaker and it takes a few days to diffuse, okay, which you think you could be able to exploit, but the effect does not seem to be large enough to generate impressive long-short portfolios and returns for these portfolios that are statistically significant. And we also show some differences. Effects are mostly stronger after 2017 and are also mostly driven by small firms with low coverage. I'm not going to talk about the theoretical model. A few references, but of course you have many more in the paper. And I stop now and I'm open to the questions. So Jocelyn.
Thank you very much, Guillaume. You want me to read the questions? I'll read them for everyone. So thank you very much, Guillaume. Very interesting presentation. First question, in fact, there are two questions which are in a sense related, and I have one which will be related to that, but I'll read these first two. Hello, are ESG shock conceptually any different from any other type of shock? And did you try asymmetric effect, good versus bad news?
So the first question is good, but so I'm gonna answer like this. I've been working prior to that some time ago on sentiments, and before ESG, I think before ESG, you already had firms, typically even Google, that use natural language processing on news articles. Typically from Bloomberg, when you have news articles about, I don't know, Apple or Microsoft or whatever, and they used NLP to extract if the news was positive for the firm or negative for the firm. For instance, I don't know, earnings or innovation, or whenever you had a keynote from Steve Jobs or Tim Cook, whether or not the news were positive, whether they were exceeding expectations, etc., etc. And so these types of news were mostly financial news, but they were not related to ESG necessarily. So you could do the same kind of exercise, and in fact it has been done. I've even done it for the direct effects on news that are not related to ESG, but that are just standard news from, I don't know, the Financial Times or Wall Street Journal or stuff like that. So it's not exactly the same. Of course, we could do an analysis, but it would require another type of data where you would add generic news that are orthogonal to ESG, if you want, and that would serve as control variable to our study. But that would be tough. That would be really tough, and it will shrink the size of the sample as well, because you will need to have the intersection of both data sets, and that would not be easy. That's one answer. For Sophia's question, it's a good question as well. So we did not test asymmetric shocks. We could have done indeed separated the equation with on one hand coefficients for positive shocks, and on the other hand coefficients for negative shocks. I wonder if we did not think about it, but in the end we decided not to go for it. Maybe it was also because it was not the way the theoretical model worked. But it's a very good point, Sophia. Thank you very much.
In fact, to follow on this, Guillaume, I was thinking that, I mean, all shots are not equivalent. I mean, here you're assuming a shot is a shot irrespective of what it is. You can think that some shots are much more important than others, and maybe these are the shots that are driving your results. So I don't know if you thought about the classification, because you can have classification of types of shocks. I mean, and you know, having a nuclear incident and having a water leakage is not exactly the same type of shock, and have quite a different impact on the reputation of the firm. And so I don't know if you thought about that.
So we've thought about it, not necessarily in terms of classification of the shock itself, because we would need to have the data for this classification. It's not necessarily straightforward. We've thought about it in terms of magnitudes. So decide and use dummies, for instance. Decide a threshold. And above this threshold, it would be like a major shock if you want, and then below a threshold, it would be a minor shock.
You take the change in rating, right? So that should account for what Jocelyn is mentioning, because there might be a much higher rating change if it's a nuclear event than a small.
True, Marie. True, yes. So that's one answer. Merci, Marie. But yes, no, we thought about using something that's stronger, like a binary variable and a cutoff threshold. But when we started doing that, then we had the issue of picking the threshold and hedging against criticism for this choice. And so at some point we abandoned this avenue. But it's an idea that we started to follow at some point, but we ended up by abandoning it.
Yes. Can I ask maybe two more questions? So great presentation and very nice results. I enjoyed it a lot. And I was wondering about what's the mechanism explaining that there is a lagging relationship when it's customers or suppliers. And I was wondering maybe for a follow-up paper, if you could investigate, because I guess not everyone has your data set, right? With all these relationships. So how do investors assess these supply chain relationships? Maybe they do it through the media. So it would be nice to know what is the information channel that drive the information. Is it that newspaper at some point mentioned that a supplier or customer was hit? So where do investors access the information, and what is explaining that in the end, and one day later, which is not so long, they finally get the information, but not immediately? And so that's my first question. And my second question, maybe also more for a follow-up paper, but I would find extremely interesting to see if it has an impact on firms' behavior. And do firms quit some of their suppliers, for example, after being hit by a shock, right? After an ESG shock to your supplier, you feel that you are suffering from that, so you prefer to change your supplier. So is there an impact on the real behavior of companies to be hit by an ESG news of a supplier, for example? And last, I would be interested to know if you tested the typology of ESG news in the line of what Jocelyn said. Environmental, social governance, is there any difference? So can you give us some more granular information if you have?
That's a lot of questions. So for the last question, I don't know. I would need to ask Vu on the data. So I think one of the reasons we didn't go into too much granularity is for reporting, because the tables are already super heavy. And so if you then split into 3 for E versus S versus G, that would be crazy. So that's one. Then in terms of the behavior and the abandoning a supplier or supplier, because you don't abandon your clients usually. It's a good question. This is something that we could maybe look at discontinuity in being a top supplier for a firm. And I don't think it would be too complicated.
Yes, from your data.
I think it's also linked to the next presentation, which makes a good transition. Maybe Professor Liu will tell us more about this. And for the first part of your question, or for your first question, it's a very good, it's something that kind of made sense to me at first, but if you ask the question, it means that it's not obvious. And so I think typically that the mechanism does not run via institutional investors, for instance. So if you take, let's say, Amundi by randomly, because Amundi rebalances not too frequently, so I don't know, at most monthly or quarterly, for many of its funds, it's not going to react that fast to a scandal or a shock, but it's going to react maybe 1 or 3 months later. What I suspect is that it comes more from super sophisticated agents on the market. So it's going to be like hedge funds or guys like that, who are going to analyze this kind of stuff and who are going to respond very, very fast. And so while maybe they can respond very fast for a direct shock, maybe they are not sophisticated enough for intraday reaction, if you want. But that's why maybe it takes a few days, 1 or 2 typically, before it impacts the supplier.
But it could also be intermediated by the rating agencies, because, for example, they have a mechanism to incorporate the controversies very fast. So the rating changes slowly, but if there is a controversy, they would incorporate that typically within 1 day, for example. So maybe it could also go through that effect, and then investors react to the change in rating. Yes.
Maybe there's an intermediate step, indeed, that comes from the rating agencies and the data providers, because the data providers themselves need a bit of lag. It can be a few hours or maybe 1 day before they adjust their own ratings internally, and which is then sold super fast to people who have access to relatively high frequency data amongst their clients. Yes.
Thank you.
With time.
Okay, maybe one last question.
I don't want to take
no more question. Okay. Well, thank you very much again, Guillaume. Very nice presentation. The next presentation by Hai Lu from University of Toronto.
Sorry, I'm unmute myself. Thanks, Professor Martel. Thanks for the opportunity for sharing this finding. I think my study complemented to the previous slide in the sense that how firms react to the transparency of the ESG practice along supply chain. So what we are doing is we look at the migration of global supply chains and see whether ESG disclosure requirement changes the firm's behavior. So I show you in this the following graph. I show you that over the past 15 years, how quickly the company, different countries mandatorily introduced the disclosure. So introduce a mandatory disclosure. So from 0 to over several hundreds, and up from now the country up to the over let me see, over the 50 countries have seen having such regulations, and also there's a voluntary disclosure along with requirement. So our research question is straightforward. Do mandatory ESG disclosure influence firms' supply chains practice? So the motivation of this study, when we started looking into these questions, we ask ourselves, can we properly account for the carbon emission when we have multiple suppliers? So there's no way actually, we can really account for the upstream or downstream parts of supply chain. And this is actually being questioned by many practitioners and also academias. And and also ESG investing has a blind spot on putting this 35 trillion industry sustainable promise in doubt because of the supply chain, practice. And then, the McKinsey has a report showing how much greenhouse gas actually comes out from the supply chain instead of the firm directly. So this graph shows us in the food and beverage industry, and over 95% of the greenhouse gas actually comes out from the supply chain. And in personal and household goods, the industry is 19 times indirect effect, compared to direct effect. And retail is slightly better, but still the indirect effect is almost 12 times larger than direct effect. So this is actually along supply chain's environmental carbon emission. How about other the perspective? Not only the environmental effect, also the huge social impact. So we have 152 million child labors and tooling in the global economy, and 25 million children and adults in forced labors. So actually, it's a global multinational company, and they have multiple suppliers from the lot of locations which have in the presence of the child labors and forced labors. So these are serious problems, and in many countries. And then we have these reporting and the regulatory limitations, and creates the opportunity for the company to hide ESG obligation in the supply chains. So in the very early, 2 decades ago, we all heard about the Nike, the company, and having the practice in Southeast Asians, and they ignored the child labor and forced labor problem, right? So we see this problem has been existing for a long time. So what we try to examine in this study is how the mandatory ESG disclosure will affect the global supply chain compositions. So this is basically very simple questions, and we try to see whether there is such an effect. So we tied this incentive to the earnings management literature. When firms try to show they are good citizens and they perform well, and they will manage the timing of earnings information, they will use the various information disclosure channels, and they're using the communication style and the tone, right? So the firm has incentive to disclose information strategically to improve their company's images. And then in the prior literature, we also show firms' voluntary ESG-related information disclosure is associated with positive market effects. The prior literature is a decade ago showing that actually is voluntary ESG disclosure reduce the cost of capital and also improve the financial analyst forecast accuracies. And then recent study showing the mandatory ESG disclosure is associated with an average negative market reactions. So this is a latest publication management science. So the empirical results seems to be mixed. And then we know the mandatory ESG disclosure could be associated with reputation cost. So if you invest in the enhanced supply chain, it will incur the cost. And in complying with ESG standards, it also is costly. And also it will attract a lot of attention, from the social activity we do, poorly in the ESG management and the practice. So mandatory ESG disclosure associated with the reputation, the cost. So in the absence of well-defined ESG disclosure standards, so we basically thinking this mandatory ESG disclosures creates incentive to be the digital transparent about their supply chain practice, but de facto ignorant about their real ESG related responsibilities. So this is what we we think in the sense. So what what the firm can do? They can switch to supplies with a more opaque ESG related information environment. And however, this repetition cost may not be sufficient to change the firm's supplier chain, the decisions, because the switching supply chain is very costly. Or firms intend to signal that they choose high quality suppliers to improve their images, corporate images, or firm may simply choose to invest in existing suppliers. So these counter arguments and combined with the incentive of switching suppliers and to leads us to a null hypothesis or mandatory ESG disclosure reputations are not associated with changes in firms' global supply chain composition. So basically, we have, they have strong incentive to hide their ESG, poor ESG practice through the supply chain migrations, or because other incentive leads to they don't do it, don't do the migrate their supply chains. So it's a prediction, is a mixed, and so we make a null hypothesis. So this is a box from conceptual, a few boxes showing how the link from the conceptual construct to the dependent variable and how we operationalize. So we take the list of the country from the Kluger or to working papers, and then we check out the 29 country and versus and also the 35 in their recent version, and 35 countries implemented the mandatory disclosure. And we use this as an independent variable, and we use a standard, the DID analysis, and it leads to the identify suppliers in the country with and without mandatory ESG disclosure, see where there's a significant link. So basically, we look at the number of new suppliers from 3 types of countries, from a country with mandatory ESG disclosure, and from the country without mandatory ESG disclosures, and the new suppliers from same countries. And also we look at percentage of the new suppliers. So these are very simple regression. We control year fixed effect and firm fixed effect and a bunch of other control variables. And here's our sample and data. We have supply chain data, and we have the ESG data from the Affinity World Scope, and we have environmental performance and social progress index data, and for our cross-sectional test. And then we also have World Bank's rule of law index to see whether once we have this mandatory disclosure, see what's the strength of the enforcement could lead to the difference in their migration strategies. And we look at the RAB risk data, and because we want to examine the consequence of the strategy we found it. So we have over 100,000 firm year observations. So we have 22,000 unique firms, and average we identify 11 supplier firms for each firms. And here's an example in our appendix showing the different country. I only take a snapshot for the first pages and showing 35 countries having this ESG disclosure requirement, and ESG which dimension, ESG or simply G or simply SNG, and also the details. So we examine all these regulations. So we take the list from the Kluger, but we actually check each country's disclosure requirement ourselves and verify it. And we have several differences, but we try to test whether this difference leads to any difference in the results, and our results basically robust to all these alternative dates and years. So let me show you some of the results, the main result, treatment effect on supply chain composition. So the main valuable interest is a mandatory disclosure dummy. So we have column 1, 2, 3 is the log of the law, the number of suppliers, and then column 4, 5, 6% of suppliers, and from the same country, from the country without mandatory disclosures, and from the country with mandatory disclosure. So from column 1, you can see after the country introduced mandatory disclosure, and the new suppliers, number of new suppliers from the focused company from the same countries actually decreases. So we see the significantly negative coefficient. And when you look at column 2, the number of new suppliers from countries without mandatory ESG disclosure actually increases. And then from the country with mandatory ESG disclosure is insignificant, basically, insignificantly different from 0. So column 1 and 2 suggest the new suppliers, some suppliers move from the same countries to the country without mandatory ESG disclosure. And column 4, 5, and 6 and showing the same results when we changing from the number of the new supplier to the percentage of new supplier. So this is our main treatment effect. So indicating the company indeed try to migrate their suppliers from the countries, home country, to the country without mandatory disclosure. So then we examine the changing of suppliers, the migration of suppliers each year. So the x-axis is the year 0 is the year when the mandatory disclosure, the standard or the policy is being introduced. So the first, the figure on the left is the number of new suppliers from same country. You see basically with the introduction of the mandatory disclosure, the number of each year basically new supplier is either stay below 0, is negative, and it continues to be negative for a few years, for 10 years. And then you look at the upper, the figure on the right, we see the new suppliers from the country without mandatory ESG disclosure actually increase and stay flat above the 0. And then for the new suppliers from the country with mandatory ESG disclosure is very close to 0. So this is the yearly regression, and this is consistent with the pooled panel regressions. So then we continue, proceed to examine the heterogeneous, the treatment effects. So first we look at see the social awareness for the country with, people actually aware about ESG issues. So we measure this using the environmental performance index and the social progress index. And we find the number, or look at the column 2, you see the number of the effect of new suppliers from the country without mandatory ESG disclosure is basically being mitigated. So we find the coefficient interaction between EPI index and mandatory disclosure, the coefficient is significantly negative, which means when those countries, target countries, people are aware about ESG issues, so this migration effect is weaker. And then the effect is the same, you look at column 5, and the mandatory disclosure and intellectual and mandatory disclosure and the social progressive index is negative again, is significant. So the effect is the same. And then we look at the legal enforcement strength and look at bottom panel. So we basically argue, well, once a country introduces a mandatory disclosure, you need a law enforcement. So if the law enforcement is strong, and then we will see this migration effect stronger. Why? If you see that the regulation introduced, if there's no enforcement, people may not care about that. So once the law is strong, you see this migration switching behavior become more pronounced. So basically the effect becomes stronger. So this is actually consistent with the company, the strategies, moving out of the country to those, country which they can hide their ESG practice. So now back to the issues of, well, investors. So do the managers of firms have such a practice? Can they fool the investors? So we look at the analyst coverage. We find when the analyst coverage is big, is higher, and basically this effect is weaker. So basically, investors, close monitoring from analysts actually has effect on firms' behavior. And as a result, from the institutional ownership, percentage of institutional ownership has the same effect when the company has a high institutional ownership, and such effect is weakened. So that's we see in the middle panels, column 2, and see the negative significant results. And then we also find that this effect is stronger for the firm when they have the financial constraint. So the bottom panel, column 2, we basically see the positive significant effect. When they have a financial constraint, they have stronger incentive doing such a migration strategy. So then we proceed to examine the other effects. And we look at see what the consequence of these migration strategies. So see whether it really works or not work. So whether when they adopt such a migration strategies, or whether the company can improve their performance. Well, indeed, once they having such a migration strategies, the number of ESG incidents being reported actually is reduced. So you look at the we interact mandatory disclosure with the migration to the customer without mandatory ESG disclosure, these interaction terms. And so we basically find that this effect is negative and significant. So switching the behavior resulted in improved ESG performance profile. So from the number of ESG incidents. And then the other arguments, people say, well, maybe this is simply correlated with the cost reduction incentives. So this is very hard, to completely rule out. So we try to share light on where this is the case. So we use the cost of goods sold and the selling and general administrative expenses, and these are 2 accounting cost measures. And we examine whether the switching behavior is associated with such, the 2 types of costs. And the bottom panel showing actually that there is no such effect. So column 2 and column 4, we examine the interaction between the mandatory disclosure and the migration to the country without mandatory disclosure, and dependent variable are the 2 cost items. We find that there's no such effect. So simply, while these results are consistent, that this migration strategies actually is not associated with cost incentives. So we did another bunch of the other robustness tests. So first one, since we are examining supply chain, so we manually check the mandatory ESG disclosure policies and see whether they explicitly mention about supply chain due diligence process. Well, they needed to report the supply chain. So we do find a few countries specifically mention this, and we pick them up and only focus on this country with the supply chain due diligence process, and we find the results are stronger. And we also examine we're taking out these 43 European countries, because European EU the 2014 directive. So we think, well, European countries are more uniform, and they are advanced in the ESG regulation. So we take out these, the 43 European countries out, and we only focus on these 72 non-European countries, and the results are robust. And even within the European countries, and we also find the results when there is some variation, and we find some results actually, from the we only focus on the subsample of European countries. And then the people argue, well, how about the effect from the voluntary ESG disclosure? So we control the voluntary ESG disclosure. We have the indicator of voluntary ESG disclosure. After we control for that, and voluntary ESG disclosure has no effect, and mandatory disclosures effect still remains. And then we do some other bias, examine bias in the statute, different DID research design, and this is all specific research design, and our results are robust. So let me conclude what we found. Well, the study is simple, and we try to see. Right now we are talking about a lot about how should we, implement this sustainability standard. So, and whether it will lead to some real effect or unintended consequences. So our studies seem to suggest enhanced ESG disclosure requirements have potential unintended consequence. In other words, firm adapt their global outsourcing practice to cope with these compliance costs. So in that sense, our study contributes to the ESG disclosure literatures by providing empirical evidence on the real effect of CSR reporting mandates. And so this adds to the growing research on the real effects of other stakeholders. And we basically besides the society, employees, and we have now all the suppliers. So the message is simple, and hopefully, the evidence convincing you, and the company actually are doing something to improve their ESG practice along supply chains. And we are not dealing with the real investment, and we just say, well, the firm try to believe they can hide this their poor practice in ESG dimensions. Thanks for your attentions.
Thank you very much, Hai. Thank you very much for this very nice presentation. Questions from the audience? There's a few that I can read already. Hello, is it possible that mandatory ESG disclosure is endogenous to the global value chain?
Well, we don't know, because we have to. That's a very good question, actually. Well, whether this ESG, I don't think this is specific to global value chain, but the ESG disclosure, mandatory ESG disclosure, might be associated with some of the other factors. So we right now at the moment we take this ESG disclosure as a given, as exogenous. But if some of this ESG disclosure is related with the ESG awareness or the other things, and we have to look into the details, what the determinants, why the company start to suddenly introduce this mandatory ESG disclosure. Good questions, yes. But right now we take this as an exogenous shock. Yeah.
The question, can I say something? I asked a question. Sure. Thank you. So first of all, thank you. It's a very interesting presentation. I think it's very well done. But the reason why I ask you this is because it's possible that some countries with poor reputation of suppliers might be pressured by outside forces to introduce legislation. So basically, that's why I asked you if it is possible that some elements or the structure of the value chains actually drives some of the disclosure. Are you aware of any research on disclosure that studies the opposite of what you're looking at?
Well, as I mentioned, this is a good question. I actually, personally myself, my co-authors read all these things. I also read a few countries, and I'm not aware. Look at these, the regulations. I'm not aware due to the global value chains or suppliers, the push it, because we are talking, well, one thing we are thinking we are going to do is separate this into the early, the adoption and adopters, and versus late adopters, because ESG things caught more attention from investor, from community in the past few years. So we rather see the things, if you just mentioned, if global supply chain is one of the driver of the ESG disclosure, and might be more significant and stronger in later periods. So we can do something along that line. But right now, based on a few countries I read, and I don't see it's due to say the suppliers pressures or on that. But we have another the field study actually looking into we basically we did a survey among the Chinese companies, because a lot of the public listed company in China were the other global suppliers. So we ask them whether whether the upstream and downstream suppliers give them pressure in recent years. But about 40%, it's interestingly 40% of these companies say, well, they do feel the pressure from upstream and the downstream suppliers or customers, but we didn't explicitly ask whether this could lead to some of the regulation changes. But it's a pressure how this ESG practice migrate along supply chain is basically people are aware along this this value chain. Yeah.
Thank you very much. Question by Sophia. I guess not all industries are equal and some can migrate supply chains easily. Did you check by industries?
We didn't specifically check the industries. We have to think about that, because in the example I just show you, different industry, right? So have different ratio in the direct and indirect effect. In the earlier one of my slides, I showing the food and retail, the different industry have different impact. So that's a very interesting question, because we might be able to see what type of industry, because if the industry has a more indirect effect come out from the weight from suppliers is heavy, and they may have more stronger incentive of doing that. So that's a good question. Yeah.
You have a question?
Are you talking to me?
Because you have your little hand risen.
Yeah, I saw that. Yeah, you
on your
raised
screen.
your hand.
So I have a question. I didn't hear what you said, Jocelyn, so I'm sorry for that.
Go ahead.
Can I ask? Okay.
Yes.
Yes. So thanks a lot. It's very insightful paper with very important results, I think. So I was wondering, in your sample, do you have mandatory disclosure requiring scope 3 carbon emissions, like ISSB, for example, has been requesting that? Because there might be very different results if you're requesting already to disclose the emissions of your suppliers and in the value chain, right? So I was wondering if you could test if there are differences depending on the type of disclosure, mandatory disclosure. And then the follow-up question is, what would be your recommendation for supervisors, right? So would you, because I think a big challenge is that firms do not hide, as you say, and would you recommend, so not only for carbon emissions, but maybe more globally on all the ESG criteria, that there is disclosure on the full supply chain? What could be the advantages, but also maybe the drawbacks of doing that? Would be very interested to have your view on that.
It's a very good question, Maria. And actually, we did it. We didn't put this in the paper. And we have the scope 1 and the scope 2. we do find the migration strategy help them to reduce scope 1 and 2, because we use the true cost data. And then for scope 3, we also find the results, but scope 3, we are very skeptical about scope 3, because this is something, so we don't want to consider even put this into this paper. But scope 1, I think, is a direct measure of the company's carbon emission, and we do find the firm with such migration strategies and scope 1, deported scope 1 from true cost, indeed, the actual effect on this. And so basically, the company perform better in the carbon emissions with such strategies. And we right now, we only report the number of the instance of the environmental violation, right? But in addition, test without being put into the paper, and we do find the results, strong results from the scope 1. We think, but the reason, the other thing is that's another thing is we want to we should add into the additional analysis, because we are talking about ESG disclosure. So it's not a specific for the environmental, right, or carbon emission. That's why we haven't put that into yet. We are debating whether we should include in the paper. But your question is excellent question, and everyone care about the climate changes. So whereas the carbon emission is basically the highest priority we are thinking to do. Yeah.
And what's your view about regulation? Would you have any recommendation for supervisors in terms of the disclosure?
I don't know, because well, I don't. What I have been thinking about is so once we have the regulation, we need to have something measurable. If we put in something not measurable, and it causes confusion. So if we don't have a good measure for scope 3, and we probably should not ask the company to disclose it, until we have a good measures. So that's something I remember one of my colleagues presented a paper using true cost data on the they try to examine was a greenwashing problem. And I remember in seminar almost 40 half an hour, 40 minutes talking about the measurement errors. So if you ask me, advice is what is the standard should do, my personal feeling is don't jump too quickly until you come up with good measures and you think that you can trustable measure it and enforce it.
Thank you.
Another question in the chat. Could you please explain a bit what you have done to address the staggered adoption of mandatory disclosure?
You mean is the regulations and the statute?
I presume so.
Yeah. So we basically we estimate for each the year, and we also I show you this we also did an event study analysis and are using Corway and Santana estimator, and we think probably this should be helpful to address the bias in the statute of DID analysis research design.
Okay. Does that answer your question online? Okay, thanks. I would have a question. I may have missed something, because in fact, when you present your tables, they're a bit different than what you have in the paper, actually, because you sort of put different columns from different tables in your presentation. But if I look at table 3 in your paper, so you have your regression on the first column is new suppliers from countries without mandatory ESG disclosure. And this is the one you reported. The effect is significant, 0.186. And then you have another column, which is the number of supplies from countries with mandatory ESG disclosure. And that's not that's column 3, actually. That's not significant. maybe I missed something. The number of suppliers is fixed at a given point in time. That is, suppose a firm has 15 suppliers. Okay, there's mandatory disclosure that comes in. It switches from, countries with mandatory disclosure to countries to firms and countries without mandatory disclosure. But I would have thought that this is a zero-sum game, that you're not creating new suppliers. So you'd think these effects would cancel out, and I said, what you win on one side, you lose on the other side. But it doesn't seem to be the case, because when you compare column 2 and 3, I would have thought that the sum would be 0. But maybe I'm missing something, given that the number of suppliers is fixed.
So, yeah, basically column 1 is suppliers from the same country. You see this is a negative effect. So they basically, we argue, they move out these suppliers from the home country to the countries without a mandatory ESG disclosure. And then the same country is confusing the same country. Yeah, as we should work home country. Basically, same country, basically the home countries. So basically, this so column 1 and column 2 basically cancel out.
Yes, I agree.
And then the column 3 is insignificant, different from 0. And then the small differences could be due to the fact that level, and because we on average they report 11 suppliers per firms. So whether I don't know exactly how they collected this number of suppliers, and they from somewhere. It's not, I'm not sure whether they can completely capture all the suppliers the company has it, but we thinking as far as they are unbiased, and they should be fine. So that's
I agree, because these columns are not exactly the same table in your paper, so that's why I wasn't sure, but that adds up. Yeah. Okay,
thanks.
Any other questions? One thing I was wondering, if I may ask, you're looking at institutional ownership, but that's in aggregate. Did you look by type of investors? Because these investors, they may have different strategies, and not all investors react the same way relative to this type of information. For example, hedge fund may not react the same way as insurance companies or investment managers.
Yes, good question. We haven't separated those socially responsible. So ideally, we would like to separate the institutional ownership into the socially responsible investing, the asset management, right, versus others like hedge fund.
Okay.
So we just take simple from database and total percentage of institutional ownership, and we think these are proxies for the percentage of the social responsible. But I think the more and more institutional investors care about ESG dimensions. So in the later period, we should be able to capture this total ownership. Should be able to capture should be highly correlated with social responsible investing. That's what we believe. But if you have the data, I would love to separate them. And because social responsible investors are care more about it. They probably closely look into the company's practice, right? So the company really cannot really hide from that, because they keep a close eye on you.
Okay. Any other question? Okay, I guess we'll stop here. Well, obviously, I would like to thank Guillaume and Hai for their presentation. Very nice presentation. Very interesting results. I thank all the participants once again. Thank you for being here, for following us. The next webinar, it hasn't been determined yet, but it should be in September. So somewhere in September, we'll keep you informed. And it should be on women on board and ESG. So we're working on finalizing this, but you should get the information very soon. Thanks, everyone. I hope to see you to the next webinar. We'll keep you informed of everything's coming. Thanks again, Marie, Sophia, and Vanessa, and the two presenters for the very interesting presentation. Thank you very much and hope to see you soon. Thank you.
Jocelyn.
Thank you very much.
Thanks you all.
Thank
Bye
you.
bye.
Bye-bye.
Take care.
Bye.
Bye.